asset. And we really need to think about many different costs when we think about how to record our plant assets in our accounting records. And remember, our plant assets include things like land, machinery, equipment, building, furniture, and we're going to see a new account today called land improvements. So let's look at land and land improvements because they're a little different, and we'll go from there. Land specifically is not depreciated because it has an unlimited useful life. But when we think about calculating the cost to acquire land, we have to think outside the box here. Not only do we include the purchase price, we include any brokerage commissions, survey and legal fees, delinquent property taxes, any taxes assessed to transfer the title on the land, and this is one that's often not included or thought of, and that would be cost of clearing the land and removing unwanted buildings. Really anything that's going to get it ready for use would be included here. So once we would determine all of these costs, we would add all of them up and we would debit land for that amount. Now, unlike land, which is not depreciated, land improvements would be subject to depreciation and it would be a separate asset account. Examples of land improvements would include things like fencing, paving, sprinkler systems, lighting, and signs. When we think about really the life cycle of an asset, basically we acquire an asset to be used for business purposes, and once we are done with that asset, we dispose of it. And we'll talk more about disposing of an asset, plant asset, later in this video. But one thing I want to point your focus to is this. If you look at this chart in the bottom right corner, you really see things called capital expenditures really versus revenue expenditures. Let's look at the revenue expenditure area first. Typically, that would be a normal expense. We would just debit repairs and maintenance expense if we're talking about a car or truck here. If you had to repair the engine or transmission, if you had to, have the oil changed, if you had to put new tires on or replace a windshield, or if you just wanted to have a paint job done. Those things would just be normal expenses that we would use the repairs and maintenance expense account for, and we would debit that. Now, if you look at the left side of the chart here, that's a capital expenditure, and that is very different. Basically, if you perform extraordinary repairs or change the use of an asset, you're going to have to actually debit the asset account itself. So in this case, if you were thinking about a truck, if you had a major engine or transmission overhaul, if you modified it for a new use, if you added to its storage capacity, or did anything that would increase the life of the asset, we would actually debit the truck account and have to revise our depreciation. Now, this is what's really important to take note here. Basically, there's a trap. If we have any of these costs in this chart, it doesn't matter if it's in the capital expenditure area or the revenue expenditure area, and they're done prior to placing the asset into service, you must include all costs in the cost basis of the asset. So if I had a paint job done before I placed a delivery truck into service, that would still actually be debited to the truck account because it had yet to be put into service. So make sure you do not slip into that common mistake that many people make. Okay, let's take a look at a problem here. It says Ogden Furniture purchased land paying $70,000 cash plus a $300,000 note payable. In addition, Ogden paid delinquent property tax of $2,500, title insurance costing $2,000, and $8,000 to level the land and remove an unwanted building. The company then constructed an office building at a cost of $700,000. It also paid $55,000 for a fence around the property, $18,000 for a sign near the entrance, and $10,000 for special lighting of the grounds. It says determine the cost of the land, land improvements, and building, and which of these assets will Ogden depreciate. Okay, so let's take a look here. Let's look at the land first. Obviously, we know in the first sentence here, we purchased land paying $70,000 cash plus a $300,000 note payable, so we can go ahead and put those things into that land column. So $70,000 goes there, and $300,000 goes there as well. Now, it also tells us that we paid delinquent property tax of $2,500, title insurance costing $2,000, and $8,000 to level the land and remove an unwanted building. As we saw earlier, all of these costs would be included in the land area because these are things that we have to include before we place this into service. So we have $2,500 for the property tax, $2,000 for the title insurance, and then the one that many people wouldn't think about would be the $8,000 to level the land and remove an unwanted building. So all of those 5 costs would be added up, and once we do that, we see that the total cost basis of the land will be $382,500. All right, let's switch gears here and look at the land improvements. It looks like we have $55,000 for a fence, $18,000 for a sign, and $10,000 for special lighting. All of those amounts would be included there. So 55, 18, and 10,000, and we add all of those things up, and we get land improvements would have a cost basis of $83,000. The building is the easiest one. In the middle of the paragraph, it says the company then constructed an office building at a cost of $700,000, and that's all we have to book there. So $700,000. So we can see that we have land is a total cost basis of $382,500. We have land improvements of $83,000 and building at $700,000. Let's talk about depreciation, and I'll just put all these things here for us to go through here. Now, remember, it is so important to think from an accounting perspective when we think about depreciation. Remember, depreciation is the allocation of an asset's cost over its useful life, and we estimate that. Remember, we have to use the information we just learned, meaning we have to make sure we correctly measure the historical cost of the asset prior to depreciating it, otherwise our estimate will be wrong. Remember, 2 main accounts are impacted. Depreciation expense is a non-cash expense that will appear on the income statement and reduce net income. Remember, accumulated depreciation is a contra asset account that appears on the balance sheet, and remember, a contra asset account has a credit balance. Our normal adjusting entry for depreciation would be to debit depreciation expense for the asset that we're depreciating and credit the accumulated depreciation of the asset we're depreciating. Now, there are 3 different methods that we're going to look at. We're going to look at straight line, units of production, and double declining balance. Let's take each one here and go through this one problem the same way so we can see each of the different methods for the same data. So we know our straight line formula is cost minus residual value divided by estimated years of useful life. And what we're going to do is we're going to look at this problem in the bottom right corner here, and we'll go through and get our yearly depreciation using straight line. Now remember, of the 3 different methods that we have, again, straight line, units of production, and double declining balance. We want to make sure that we look at each of these in particular, and remember, you have a choice. Typically, you can choose which method you're using, and if you have a choice, go with the easiest one, and that's what straight line is. All right, so let's look at this. It says Papa's Fried Chicken bought equipment on January 2nd, 2013 for $39,000. The equipment was expected to remain in service for 4 years and to perform 11,000 fry jobs. At the end of the equipment's useful life, Papa's estimates that its residual value will be $6,000. The equipment performed 1,100 fry jobs the first year, 3,300 the second year, 4,400 the third, and 2,200 the fourth year. And they want us to do what's called a depreciation schedule for each of the methods, and that's what we'll do, but on this first slide here, we'll work through some data to help us fill that in on the next slide. Remember, residual value is what we estimate the asset to be worth once it's fully depreciated. And our residual value needs to be our final book value at the end of its useful life. We can never go below the residual value at the end of its useful life. Now, remember, in this problem, we know we have a cost of $39,000. We're going to subtract the residual value of $6,000, and we're going to divide that by 4 years. So we see that that comes out to be $33,000 divided by 4 years, and we do that calculation, we get $82.50 per year. So that will be important for us. It will be the same amount of depreciation each year, and that'll be $82.50. All right, so let's see how we do the next schedule here. Now remember, in this particular case, when we fill this out, it's not going to be overly difficult from the perspective of straight line because it's going to be the same each year. It will change a little bit as we move to the other methods. Let's take a look at this. The way you always want to start these out is you want to start out with date of purchase, and then we can fill in the number of years. So we have year 1, we have year 2, we have year 3, and we have year 4. Now, the cost is $39,000. We know that. It's not going to change. That will remain the same. And remember, on the date of purchase, we do not have any yearly depreciation or accumulated depreciation. We just have our starting book value of $39,000. Now remember, to get our book value calculation, we must always take our cost minus our accumulated depreciation equals book value. Now you must go back to the very top. Always take the $39,000 minus whatever the current year's accumulated depreciation balance is to get the book value. Okay, so we know the yearly depreciation is going to be $82.50 per year. And let me just put that up here so we know. All right, now, obviously, after the end of year 1, the accumulated depreciation will have the same amount. Now, once we get here, we always take the book value, again, this $39,000 right here, and we want to subtract out the $82.50, which is the current balance of accumulated depreciation. So that minus that equals $30,750. All right, let me erase this. Once you can see that there, we'll go back and be able to do some different things there. All right, now, again, second year would be $82.50 for the yearly depreciation. That will never change. Now, how do we get our new accumulated depreciation? We will take this $82.50, the previous year, plus the current year, and that will equal $16,500. Now, here's where you got to be careful. Make sure you always go back to the top to get our new book value, $39,000 minus the $16,500 equals our current year's book value of $22,500. All right, so hopefully you're understanding the flow of this. Let's keep going and finish it out here. Another year of $82.50. Whoops, there we go, $82.50. All right, let me erase all this here so we can show the new calculations. All right, so now I take this current year's here, accumulated previous year's accumulated depreciation, plus $82.50. We know that that comes out to be $24,750, and now we take $39,000 minus the $24,750, and that comes out to be $14,250. All right, last year would be $82.50. Let's erase this to get our new amounts here. You take this plus that. That comes out to be $33,000. And then to get our final book value, that comes out to be $39,000 minus $33,000 equals $6,000. Now let's talk a little bit about this. the first thing you want to realize is that this $6,000 number right here, and I'm going to circle that now in red. It seems to be not coming up there. Let's take a look at this right here. This is what's referred to as our residual value. Remember, it has to be that. It cannot go below that, and that's what our book value is at the end. Now, we also know this number here, we can refer to this as our depreciable cost or depreciable base. Either term is correct. And remember, our depreciable cost or base, to get that amount, we always would take the numerator. It's our cost minus our residual value. And we know that our cost was $39,000. We know our residual value was $6,000, so we know that our depreciable base was $33,000. And that matches up to what we got at the end. Notice this has to work out this way. If you do not have your final accumulated depreciation be your depreciable cost and your final book value be your residual value under the straight line method, you made a mistake. So it's a good thing that we can actually check our answer before we know as we go forward here. All right, that concludes our straight line. Let's take a look at the next method here, and that is our units of production. Our formula changes a little bit, and that is, instead of using estimated years of useful life, we have to use estimated units of useful life. And then that will yield what's a depreciation expense per unit. So let's look at this here. We know that our cost is $39,000. We know that our residual value is $6,000. Those things are not going to change. We divide this now by not years of useful life, 4 years, but we said in the second sentence here, the equipment was expected to remain in service for 4 years and to perform 11,000 fry jobs. The 11,000 fry jobs would be the estimated units of useful life, so we'll divide that by 11,000 fry jobs. So we know that it's 33,000 divided by 11,000 fry jobs, and we see our depreciation expense per unit in this case would be $3 per fry job. So now that we have that, we need to use this data in this problem. We know that we have to, in year 1, it's 1,100 jobs. Year 2, it would be 3,300. Year 3, 4,400, and 2,200 for the 4th year. So the schedule for this particular method is a little different because you can see that they added a units column. We will need that specifically to help us with this. We will still set it up the same way. We know we have DOP, we have year 1, we have year 2, we have year 3, and we have year 4. Now we know the cost still is $39,000. That won't change. Here is where we need to be attentive. So we know the number of units each year. Obviously nothing's going on here the first year, and our book value is our $39,000. Now we said our depreciation expense per unit is $3 per fry job. So that we're going to put there. And we will now fit in the number of units. We had 1,100 here. We had 3,300 in year 2, 4,400 in year 3, and 2,200 in year 4. We will simply multiply this by the rate times $3 per job. We know that it's going to be that's our rate. Now, to get our yearly depreciation for year 1, we will simply take that 1100 times 3, and notice that we will get 3300. Our accumulated depreciation, obviously we didn't have any from our first year, so we just have the 3300. And remember, we'll still figure out the book value the same way. Cost minus accumulated depreciation equals book value. Notice that we're at 35,700 at the end of the first year. Now, our yearly depreciation will change for year 2. We take the 3,300 times the $3, and that comes out to be 9,900. Now, let's go ahead and erase this information here. We know that to get this, do that again. This, we would take 3,300 plus the 9,900. That equals 13,200. And we are at 25,800 for the book value because we took 39,000 minus the 13.2 equals 25.8. All right. Then, in year number 3, we take 4,400 times $3, and that comes out to be 13,200. All right, so let's go ahead and do our new estimates here for new totals for accumulated depreciation. We would take the previous year plus the current year, and that would be 26,400. And to get this, the book value, the 39,000 minus the 26,400 comes out to be 12,600. Okay, so I guess I would challenge you here. Hopefully you can see, again, we know that in this particular case, we know that this needs to be our depreciable cost, and we know that this needs to be our residual value. So let's see if it works out. So let's get rid of all this here. So we know this needs to be 33,000, and we know this needs to be 6,000. So let's see what happens. 2,200 times $3 is 6,600. Notice that we take this plus that to get 33,000, and that works out. And then we take the 39 minus the 33, and that does equal our 6,000 residual value. So again, just like straight line, units of production method must also work out. So we know again if our calculations are correct when we finish the schedule. Okay, let's go to the next method, and that is probably the most difficult one of all, and that is the double declining balance. Now here's what we have to think about as far as double declining balance. Make sure you realize that, and I'm starring it here, double declining balance is an accelerated method of depreciation, meaning that we take more depreciation in earlier years. The reason why a lot of people like this particular method is when you think of the matching principle back in New Accounting Principles of Accounting 1, matching principle basically states that you must match revenues and expenses in the period in which they occur. And when we think of double declining balance, taking more depreciation in earlier years really would be a good method as far as the matching principle goes, because think about it, typically when does an asset generate the most revenue or be its most productive? And that would be obviously when it's new. So there are a lot of people that believe that this is a good way to match up the revenues that the asset is generating for us and really offset the expense with that, so with this higher amount of depreciation in the earlier periods. Now, the first thing you have to do is calculate your double declining balance rate. And the way that we do that is we take 1 and we divide that by the estimated years of useful life, and then we multiply it by 2. So in this case, we're going to have 1 over 4 years times 2. That really comes out to be 2 over 4, or 1/2, or 50%. So in this case, our rate is 50% that we will use. That's really all the calculations we have to do on this page. We'll just go in here to the schedule to see how we work out the next piece of this. All right, the first thing I'll do is make sure we know our double declining balance rate. We'll put that up here is 50%. Okay, so this is going to be again set up the same way. Date of purchase, year 1, year 2, year 3, and year 4. Now, what we want to make sure that we realize here is this. Cost still is $39,000, nothing here, and we know our book value to start off with is our cost basis of $39,000. Now here's where this method differs. In order to get yearly depreciation, you must take the previous year's book value and multiply it by our double declining balance rate. So for year 1, what we would simply have to do is take 39,000 times 50%. That was the previous year's book value of 39,000 times our double declining balance rate. That comes out to be 19,500. All right, so now we have our yearly depreciation for year 1. Obviously, we have no other accumulated depreciation, so that current balance is going to be 19,500. And we still figure out our book value calculation by taking our historical cost, which was 39,000, minus our accumulated depreciation, and that comes out to be, in this case, the same number, 19,500, because it was exactly half of it. So any 4-year problems are pretty much going to start off this way, the same answer for the year 1 all the way across. All right. So here's where you've got to be extremely careful. We do the same process for the second year. We take the previous year's book value, which would be 19,500, times 50%. And we can see that again, I'll just draw that up there so we know, and again, you're multiplying that to get your year 2 depreciation. That comes out to be 9750. All right, so we do that. Notice now again, let me erase this so we can keep going nicely here. We know that to get this accumulated depreciation for the second year, we take previous year plus what we have now, 9750. That comes out to be $29,250. Again, our book value, 39,000, minus our accumulated depreciation, comes out to be 9750. Okay. Here then we keep going. What we would typically do next would be to take 9750 times 50%. Now, if we do that, we know that that's going to cause some problems. Because remember, we have to always have our accumulated depreciation ending balance must never go above our depreciable base, or cost. And that equaled 33,000. Well, if we do that, we're going to get an amount above the 30. We only need $3,750 to get to the $33,000 depreciable base. And if we would take the 9750 times 50%, that's going to be over $4,000, so we know that that's going to be something that's going to cause us to have an issue. So we know this cannot work, the 9750 times 50%. So what you have to do, knowing that you would exceed the 33,000 in this area, you have to force it to work. So this needs to be 3750. You force it, put a little asterisk there, and you would put the little explanation down here, maximum depreciation allowed in year 3. Now, the other reason is this is our depreciable cost or base. Now, this number can never go below 6,000 in this problem. So we can see how I got the 3750. You take the difference between 9750 here, and you got minus the 6,000, you would get 3750. So this is obviously our residual value. Now here's what you have to remember, and that is we need to then make sure you know there's no depreciation in year 4. And we'll go ahead and erase this stuff here. I'll want to rewrite this anyway. So this would still be 33,000 and this would still be 6,000. Again, this is our depreciable cost, and this is our residual value. Okay, so let's pause here a moment and let's just talk about this. The double declining balance will really never come out exact. I've never seen a problem in my years of teaching do that before. So make sure that you know that if you finish early, you stop and you cut off where you need to. Now let's just say that you get to year 4 and you don't have enough to get to your depreciable cost of 33,000 and therefore your book value being 6,000. You would actually have to take more depreciation and have to force it to get to those numbers. So no matter what, if you finish early, that's okay, and if you get to the point where you're done and you don't have enough, you must take it so that you do have enough to get done the problem and get to your residual value that's necessary. All right, so let's take a break here and we'll come back and continue the video going into depreciation for a partial year. All right, one thing you want to make sure you also pay particular attention to is a lot of times they may ask you for depreciation of a partial year, and in most of the cases, well, in all the cases in the previous examples, we did it for an entire year. So let's just take a look at this. It says here on July 31st of 13, Logan Services purchased a copy machine for $40,400. Logan Services expects the machine to last for 4 years and have a residual value of $2,000. Compute depreciation expense on the machine for the year ended December 31st, 13 using straight line. Okay, so straight line again is our cost minus residual value divided by estimated years of useful life. So in this case, we can see that we have a cost of $40,400 minus a $2,000 residual value, and then we would divide it by 4 years. Okay, that comes out to be $38,400 divided by 4 years, or $9,600 per year. Now, that's not the answer they're looking for, because basically they bought the thing on July 31st of 13, and we only have to depreciate it up until December 31st of 2013. So let's think about that. Would really be from August all the way through the end of December. Really August 1st, let's do that. August 1 through December 31. If you think of that, you think of August, September, October, November, and December, that would be 5 months. So you would have to then multiply the 9,600 times the 5 out of 12 months, and when you do that, you get 4,000. So you would need to say your answer for the year, partial year, would be $4,000. Again, be careful with counting the months. A lot of people sometimes think it's only 4. You got to make sure you include all of August and all of December. Okay, then we get into a very similar topic to depreciation, but really it's when we'd have to deal with natural resources. And if you think about it, obviously we could purchase things like coal mines, oil fields, or gas fields, and we would extract those natural resources from the earth, and obviously we'd have to have some way of accounting for this. So remember, it's depletion, not depreciation, that we would use here. It's exactly the same type of process, except instead of depreciation expense, it's depletion expense that we would debit for the adjusting entry and credit and a contrasted account called accumulated depletion. Again, the formula here will be similar to the units of production method we just saw, and the way we do this is we would get a depletion expense per unit by taking the cost minus residual value divided by estimated units to be extracted, and then once we do that, we would multiply our depletion expense per unit times the number of units extracted for the year, and that would give us our depletion expense for the year. So it says here in this problem, Sierra Mountain Mining paid $448,500 for the rights to extract mineral assets from a 500,000 ton deposit. In addition to the purchase price, Sierra also paid a $500 filing fee, a $1,000 license fee to the state of Nevada, and a $60,000 amount for a geological survey of the property. Because Sierra purchased the rights to the minerals only, it expects the asset to have zero residual value. During the first year, Sierra removed and sold 50,000 tons of the minerals. Make journal entries to record A, the purchase of the minerals, which is, we're going to use a minerals as an asset account, and then payment of fees and other costs, and depletion for the first year. Now, the first thing we have to remember here is that we have to include all of the costs. Hence, that's why we have to do A and B. So let's look at this. We know the initial cost is going to be $448,500. We know that, so that would really, but it's going to be focused on in Part A. Part B, we have to also include the filing fee, which would equal the $500. We know that the license fee, that comes out to be $1,000. And we know the survey comes out to be $60,000. So these things will be in Part B. Now, important to note too, when we get to C, we know that the residual value equals 0. All right, let's figure out our depletion expense. In this case, it's going to be per ton. So we would take our cost, which was the $448,500, plus all the other costs that we have, the $500, the $1,000, and the $60,000, divided by 500,000 tons. Now, why, people are asking, why is, you don't subtract anything? Well, typically, in this case, you would not, because the residual value was 0 that we were told there. We did not acquire the land with that, so there was no residual value at all, any value to putting anything on the land. All right, so let's look at this here. We have 448.5 plus 500 plus 1,000 plus 60,000. That comes out to be 510 minus 0 divided by 500,000 tons. And that comes out to be 50. It looks like $1.02 per ton. And then to get our depletion expense for the year, this would be C, we would simply take $1.02 per ton times the number of extracted units for the first year, 50,000, so we know that we have depletion expense for $51,000. Now, we can take this information that we've calculated here and we can do it in the journal on the next page. Let's do that. In A, we will just simply debit minerals for 448,500, and we're going to credit cash because we're paying cash for that, so 448,500. So that will be the journal entry to record the purchase of the minerals itself. Then we would add all the extra costs into the minerals account by debiting the same account, minerals, and those totaled out to be 61,500. Again, that was 500 plus the 1,000 plus the 60,000. Okay, and obviously we're going to give them cash for that. And then remember, we had to include the depletion expense journal entry for the first year. We debit that, depletion expense, minerals, and we credit accumulated depletion minerals for 51,000. Again, our $1.02 per ton times 50,000 tons that we extracted. Okay. The next topic we'll take a look at here is lump sum purchase of assets, also referred to as basket purchases. And what we have to remember here is that it's very common that we would have a situation where we would buy multiple plant assets in one transaction. So what the problem there is that we need to properly cost these assets and value them on our books appropriately. So what we do is we have an appraisal done to help with the process of valuing that so we can get the right cost basis on our books. So let's look at this problem. It's not too difficult. It says Deadwood Properties bought 3 lots in a subdivision for a lump sum price. An independent appraiser valued the lots as follows. Lot 1, 70,500. Lot 2, 235,000. Lot 3, 164,500. Deadwood paid $210,000 in cash, and that's for all the lots in one lump sum purchase. Record the purchase in the journal, identifying each lot's cost in a separate land account. Round decimals to 2 places and use the computed percentages throughout. Okay, this is a pretty simplistic issue to deal with. The first step would be to add up all of the appraised values. So I'm going to add up the 70,500, the 235, and the 164.5. That comes out to be 470,000. And then what we have to do is we have to divide each of the lots by the total. So we're going to divide all of the lots by the 470,000. And if we take the 70,500 by the 470, that comes out to be 15%. 235 divided by 470 is 50%. And the 164.5 divided by 470 comes out to be 35%. Obviously, we add all these up, they come out to be 100% there. It has to equal that. All right, so to define the cost basis for lot 1, I'm going to take 15% times the $210,000 that we paid in cash, and that comes out to be $31,500. For lot 2, we do the same process, 50% times the $210,000, and that comes out to be $105,000. And finally, lot 3, the 35% times the $210,000 comes out to be $73,500, and we add all those up. Obviously, we get $210,000. So think about this: they got a $470,000 of appraised lots, and only paid $210,000 for them. And now we have the appropriate cost basis for each of the lots to put in a journal entry. So to do that, we'll go to the next slide, and it's a pretty basic journal entry here. They didn't give us a date, so we'll just leave that blank. They said to put each of these things in a separate land account. So for each account, I will debit land and the specific lot. So land lot 1 was a debit for $31,500. Land lot 2 is a debit for $105,000. I'm just taking the values that I had from the previous slide. And land lot 3 comes out to be $73,500, and obviously we're going to credit and give them the $210,000 cash. So just make sure that you do add up all the appraised values, divide by the appraised value total for each individual asset you're buying, and then multiply the percentages by the purchase price. Now just be careful, sometimes you may not be taking on a note payable or something of that nature, and not crediting cash. You'd be crediting note payable or something of some other liability if you're buying it with other ways than cash. So just be on the lookout for that. All right, we saw early on that we obviously would have to deal with disposing plan assets. Basically, once they wear out or become obsolete, we have 3 different ways to dispose of them. Obviously, one would be to throw it out and just discard it. That would be probably very uncommon, but still a possibility. You could potentially sell the plan asset. That would probably be a better way to go if that's possible. And then the third way, even though it's not a focus or covered in this particular course, is that you would exchange a plan asset for another asset. Again, we won't be really doing any of that here. If you move on to intermediate accounting, you'll see it in that class. So here are the steps that you want to make sure that you do, and that is when you dispose of a plan asset. First thing is bring the depreciation up to date. That's a common mistake. You may have last depreciated at the end of the year and it's now April. Well, you got to make sure you account for those first 4 months if it's the end of April. So bring the depreciation up to date is important. Second would be to remove the old asset as well as the associated accumulated depreciation from the books. So we're going to be getting rid of those things. We make sure that if we have it, we record any cash that we received or we had to pay. And then here's the one that's really important, and that is make sure you appropriately determine the amount of any gain or loss that you would have. Now remember, if you have a loss, you will always debit a loss account, and then if you have a gain, you will always credit a gain. Think of it from an income expense perspective. A loss would be kind of like similar to an expense, hence it's a debit, and then a gain would be similar to revenue. That's why you would credit. So to do that, you calculate the loss or gain by using the following formula. Always take your sales proceeds that you got. If you throw it away, you get 0 proceeds, so it would be 0. And subtract out the book value of the asset. And if it's a positive number, it's a gain. If it's a negative number, it is a loss. So let's look at a couple of these here and see how we do. It says on May 31st, 2007, 16, Choice Landscapes discarded the equipment that had a cost of $29,400. Accumulated depreciation as of December 31st was $27,000. Assume annual depreciation on the equipment is $2,400, and journalize the partial depreciation and then disposal of the equipment. Okay, so the first journal entry we have to do will obviously be on the 31st of May, that we have to get the appropriate depreciation up to date. Okay, so let's think about this. We have to go from really January 1st through May 31. So if we think about that, January, February, March, April, May, that would be 5 months of depreciation that we would have to take. So we can simply take the $2,400 times 5 out of 12 months, and that comes out to be $1,000. So let's go ahead and do that. We're going to debit depreciation expense for the equipment, 1,000, and we will credit accumulated depreciation equipment for $1,000. So now once we've done that, that's basically changed the accumulated depreciation from $27,000 to now $28,000 that we have in that account. All right, so let's think about this. It says that we're throwing it away, we're discarding it. So we know that we're not getting any cash. So if we calculate our, it's going to obviously, unless our book value is 0, it will have to be a loss. So let's do this here. We know that our current book value would be $29,000 minus, which is our cost, so we'll do book value, the $29,400 minus the $28,000 current balance of accumulated depreciation. So our current book value is $1,400. So obviously our sales proceed, to get our gain or loss, we take 0 minus $1,400, so we know that it's a loss of $1,400. All right, so now remember, we must remove both the accumulated depreciation and the asset from the books. So let's do that. We get rid of accumulated depreciation by debiting it because it has a credit balance. So we would debit accumulated depreciation equipment for $28,000. Now we know that our golden rule is always debit losses and credit gains. So we know that in this case we have a loss. We have to do loss on disposal. For $1,400, and I would credit the equipment itself because we're getting rid of the equipment, we're disposing of it, it's leaving the business for the historical cost of $29,400. So here in this case you can see that we had a situation where we threw something out and we incurred a $1,400 loss. Remember, this loss will show up on our income statement and at the end of the day lower our net income. All right, let's have you take a look at this next one here. On January 2nd of 2014, Pet Salon purchased fixtures for $48,200 cash, expecting the fixtures to remain in service for 9 years. Pet Salon has depreciated the fixtures on a straight-line basis with a $5,000 residual value. On May 31st of 2016, Pet Salon sold the fixtures for $30,600 cash, record both depreciation expense for 2016 and sale of the fixtures on May 31st of 16. Okay, what I'd like you to do now is pause the video and right here and go ahead and see if you can work through this, and then I'll go through it with you. So pause the video and give it a try. Okay, let's see how you did. The first thing we want to try to do is to figure out what our current depreciation is and bring all that up to date. So our cost basis we know is $48,200. We have to do our straight line formula. We know that's cost minus residual value divided by estimated years of useful life. We know that our cost was $48,200. Our residual value was $5,000. And we have a 9-year useful life. That comes out to be $4,800 per year. Now, we have to see how long we've done this for. So, accumulated depreciation will need to go from all the way from January 2nd of 14 through May 31st of 16. So, we know that for 2 years, from January of 14 to January of 16, we have that. So let's go ahead and do that easily. We know that that's $9,600. Plus, we also have to include our partial year. And to get the partial year, we'll have to take our $4,800 per year amount times 5 out of 12 months. Again, all the way from January 1st through May 31st. That's an extra $2,000. So we'll add that down here. So our current balance in accumulated depreciation through 5/31 of 16 is $11,600. All right, now we can calculate our book value and then our gain or our loss. So let's see how we do this. We have our book value is our cost minus accumulated depreciation. And we have $48,200 minus our $11,600 that we just calculated. So our book value comes out to be $36,600. All right, now in this particular case, we sold it, so we do have our sales proceeds. So we have to get our gain or loss, sales proceeds minus our book value. Let me write this over here. Come on in. Sales proceeds minus book value. Our sales proceeds, or the cash we got in exchange, was $30,600 minus our book value of $36,600. And it looks like we have another negative number here. We know we have a loss of 6,000 even, it looks like. Yes. 6,000. Okay. All right, we can no doubt use this information to do our journal entries. We'll do those over here. Let's record the depreciation first. So we know on 5/31 we would debit our depreciation expense for fixtures, and that was for really just, we would have recorded it all the way through December 31st of 15. So we'll just go ahead and put the 2,000 to bring it up to date, and then we would credit our accumulated depreciation expense fixtures for the 2,000. Now, typically I like to skip spaces between journal entries, but I don't have enough room here so that we can get all this in. So just realize that typically I would have skipped a space. Now we want to do the disposal journal entry. So we know we're going to debit our cash, the amount of cash we're getting in. That's the $30,600. We know that we're going to debit and remove from the books the accumulated depreciation of the fixtures, which was a total of $11,600. We know that in this particular case, we calculated that we had a loss. Remember, our rule for that is debit losses and credit gains. So we would debit loss on disposal, and that was the $6,000. And notice then we would just credit fixtures and remove them from the books for their historical cost of $48,200. Okay, so hopefully you understand that it's important to get the depreciation up to date first, and then make sure that you properly calculate the current asset's book value, so that you can then correctly calculate the gain or loss on disposal. Okay, our last major area that we have to deal with here is talking about intangible assets. And basically we're going to go through these. There's really not a whole lot of problems to do. We'll do a couple different things, not overly difficult. But let's take a look at these. Obviously, intangible assets are things that would have no physical form, and they would include things such as patents, copyrights, trademarks, licenses, franchises, and goodwill. And we'll talk about each of these as we kind of go through here. Now remember, we always record intangible assets at cost. Typically, we really expense them through a process called amortization, which is very similar to depreciation. And we basically allocate the cost of the intangible asset to expense over its useful life, very similar again to depreciation. And remember, the important thing to note is that only intangibles with a definite life are amortized. The other thing, even though we won't really do a whole lot with this in this particular course, is that it's still important to know that you must test intangible assets annually for what's called impairment. And that basically happens when you have the fair value of the asset become less than the book value, and then we would have to actually show and record a loss when an impairment would occur on an intangible asset in the journal entry. Let's look at a couple specifics here. Patents, basically that's a federal grant conveying an exclusive 20-year right to produce and sell an invention. And an invention could be a process, product, or formula. And basically you would have a separate patent account, and so I'll just write that as a T account here. So you can see basically you'd have patent, and this would be an asset. And it would just have a regular debit balance that we would normally see an asset account have. So you would just debit that when you acquired the patent. Let's look at a problem here and see how it's a little different than depreciation. We think of having to amortize it. It says here on March 1st, Twist Company purchased a patent for $168,000 cash. Although the patent gives legal protection for 20 years, the patent is expected to be used for only 5 years. 1. Journalize the purchase of the patent. 2. Journalize the amortization expense for the year ended 12/31/16. Assume straight line. Okay, so let's go ahead and do this here. Straight line. Again, you would have your cost minus residual value divided by estimated years of useful life. Alright, so in this case we paid $168,000. There was no residual value here, and the estimated years of useful life. Now you got to be careful here, because even though we know it gives a 20-year protection, we're only going to use the patent for 5 years, so that's what we would need to put as our amortization useful life. So we take the 168 divided by 5 years, we get $33,600 per year. Now the thing that you've got to be careful of here is that really we purchased this on March 1, And so we only have to go from March 1st. So we have to go from March 1st all the way through December 31st. So if we think about that, really March 1st through December 31st, the only months that would be excluded would be January and February. So obviously this would be 10 months. So we have to multiply this by 10/12. And once we did that, we would get $28,000 for 2016 amortization expense. All right, so now we can do our journal entries. So let's go ahead and do that on the next page here. On the date of purchase of the patent, which was on March 1st, we would just debit patent like they told us to, the actual asset, $168,000, and we paid cash, so we just give them cash for that same amount. So that's all you do for that. Now here's the important thing to remember. At the end of the year, we have to do our amortization expense entry. Now this is where it differs from depreciation. We're going to similarly debit not depreciation expense but amortization expense for the patent. That's very similar. Really debit the expense for the asset, $28,000 that we calculated on the previous slide. Here's where it differs. Where we would use a contra asset account like accumulated depreciation, or during that with natural resources, accumulated depletion, notice in this case we're actually not going to do that at all. We're actually going to credit the actual asset patent for the $28,000. The reason is we can just reduce the amount of the patent account because it's an intangible asset and we don't have to worry about a contra asset account. A couple other intangible assets, again, franchises. Basically, you're allowed to kind of replicate a business model, and you can sell goods or services under specified conditions. Obviously, McDonald's and Subway would be well-known business franchises, and typically a person goes out and purchases a franchise and is able to run that business very similarly with the support of the main franchise. And then obviously those franchises would be required to pay royalties to the main franchise, franchise holder. That would allow them to use their trademarks, products to sell, that type of thing. And then licenses, obviously, in this particular example, this particular course would be basically privileges granted by a government to use a public property in performing services. Really not going to talk too much more about that. Again, you would see more of this information in the intermediate accounting if you go on to that class. I will spend a moment on goodwill. This is something that's, I think, important to know. Basically, goodwill is the value that's paid above the net worth of a company's assets and liabilities. So let's think about this. Let's say that I'm looking to buy or start a car dealership, and I really have two choices. I could buy a current car dealership down the street, or I could go buy or rent some property nearby and start a brand new competing business. So let's think about this. Let's say I approach the owner of the current dealership and I ask them would they be willing to sell, and they say sure. And we have an appraisal done and the fair market value of the business is $1 million. I say, sure, I'll pay $1 million for this, and the owner comes back and says, no, I want $1.3 million. Is that a reasonable request? Well, that may or may not be. The reason is, let's say that the business is a very reputable business. It's been long established. It has a large amount of customers, repeat customers. It has a good employee staff. And so what the owner is doing there is actually saying, no, I'm not going to sell unless you pay me above what the net worth of the company's assets and liabilities are. So let's say we go back and forth and I agree to pay $1.2 million. Well, because the business was valued at a net worth of $1 million, the $200,000 difference I would pay is what is called goodwill, and that would be an intangible asset. So it would be recorded by the acquiring company when it purchases another company for more than the market value of the net assets acquired. And remember that we would not amortize that. We actually would test that for impairment. So let's look at this problem. It says here, Princess has acquired several other companies. Assume that Princess purchased Kettle for $11 million cash. The book value of Kettle's assets is $12 million. Market value is $16. And it has liabilities of $12 million. Market value is $12 million. Okay, so basically the market value of the assets is $16 million. I would subtract out the market value of the liabilities, which is $12 million. So my net assets come out to be $4 million. Now, basically, Kettle actually purchased them for $11 million. So if we think about it, we would take the purchase price of $11 million. I would subtract out the net assets of $4 million, and that would equal the goodwill in this case of $7 million. So how do we record this? So we did this. How do we record the purchase of Kettle by Princess? So the way that we would work this journal entry would be to debit assets in general, and those assets were worth $16 million. I would have to debit the intangible asset goodwill for $7 million. I would credit the liabilities for $12 million, and I would credit cash for the purchase price of $11 million. So you can see there how that would be something where you would make sure that you would have to record. And again, it's not very uncommon that companies would choose to take an established business and pay a premium for it. Think about it, the difficulty, going back to my example of setting up a car dealership, you could have a situation where if you had to start that from scratch, it could be very difficult, and you may not be able to be successful with that competitor very close by. If you could purchase that successful dealership, even though you had to pay a premium for it, you would have your infrastructure, a reputation, employees, all that available to you, and that could be a way that would be maybe much more successful for you. Okay, that concludes this particular lecture on your planned assets, your depletion, natural resources, and intangible assets. Why don't you head over to the homework and see how you do on those problems.
You